Imagine a company making millions in profits, growing every year, but secretly it's walking on a tightrope toward disaster. Why? Because of one metric, seemingly harmless, that can destroy even the most successful businesses. Today, we uncover this silent killer and how companies unknowingly let it control their fate. 1. The illusion of profitability. Most companies operate under the belief that as long as profits are rising, everything is perfectly fine. The numbers look great on paper, investors are smiling, employees feel motivated, and CEOs often give themselves a well-deserved pat on the back. But here's the twist. Profit alone doesn't reveal the full picture. A company can appear successful while quietly heading toward disaster. Take the example of a company we'll call Technova. And in 2025, Technova reported $50 million in profits, a 20% increase from the previous year. On the surface, it seemed like a story of unstoppable growth. But behind the headlines, the company had a serious problem: revenue growth rate. Every decision, every campaign, and every budget was focused on pushing this number higher, often at the expense of cash flow, customer satisfaction, and long-term strategy. This obsession created a dangerous blind spot. While the team celebrated quarterly milestones and impressive charts, small cracks were forming in the company's foundation. Operational inefficiencies, unhappy customers, and overextended budgets were quietly building pressure. What looked like success was actually a ticking time bomb, proof that rising profits alone can be dangerously misleading. What 2? Meet the silent killer, the wrong metric. Here's the shocking truth. The metric that destroys profitable companies isn't always visible. It's often the one executives obsess over the most. For many, that metric is short-term revenue growth, sometimes even monthly active users, new signups, or gross sales volume. Why is it dangerous? Because focusing solely on these numbers can create a false sense of security. Companies might look profitable while burning cash, neglecting quality, or alienating their best customers. Take Technova again. They invested heavily in acquiring new customers through expensive ads, offering steep discounts, and giving away free products. Revenue grew, but so did customer churn. Their loyal customers felt ignored, service quality dropped, and operational costs skyrocketed. Now, the short-term metric looked great, but it masked a long-term disaster brewing beneath the surface. This is a story repeated over and over. Businesses celebrate the wrong number, thinking it reflects health, when it actually hides danger. 3. The psychology behind obsessing over one metric. Why do smart leaders fall for this trap? It's psychological. Numbers are comforting. They provide clarity and a sense of control. When you see a graph climbing upward, your brain releases dopamine. You feel successful. But here's the problem. Numbers can lie. They are a lagging indicator, showing results after the damage is done. And if that number becomes the main focus, the company starts making decisions to boost it artificially rather than improving the real business fundamentals. Technova's CEO was a classic example. Every board meeting focused on monthly revenue spikes, ignoring cash flow, customer satisfaction, and employee burnout. The CEO felt confident, but in reality, the foundation of the company was weakening. This is why the wrong metric is so deadly. It tricks even intelligent leaders into thinking everything is fine. 4. Real-life examples. Let's look at some real companies who fell into this trap. WeWork. Before its spectacular crash, WeWork focused obsessively on rapid growth and valuation metrics. Revenue was increasing, and the media loved them, but they ignored sustainable profits, operational efficiency, and long-term planning. One bad metric obsession led to billions in losses almost overnight. Theranos. The company's growth metric was market hype and funding rounds. They ignored the actual performance and reliability of their product. Obsessing over fundraising numbers rather than real results led to one of the most infamous corporate collapses in history. Blue Apron. They chased user acquisition and growth at all costs. While revenue initially surged, customer retention suffered, costs skyrocketed, and eventually the company struggled to survive. The common thread? All these companies were profitable, or appeared to be profitable, while being blind to the one metric that truly mattered: sustainable business health. 5. The true metric that matters. So what is the metric that companies should actually focus on? It's not flashy. It's not exciting in a boardroom, but it's simple. Customer lifetime value, CLV, compared to customer acquisition cost, CAC. Why? Because this metric shows whether a company is truly creating value. Are customers sticking around? Are they profitable over time? Can the company scale sustainably? If CLV is lower than CAC, the business is in trouble, even if it looks profitable right now. If CLV is high, profits will naturally follow, and growth becomes sustainable. Technova, if they had focused on this, would have noticed that while revenue was increasing, the cost of acquiring new customers exceeded the value they brought in. By paying attention to CLV to CAC, they could have optimized marketing spend, improved product quality, and retained loyal customers, avoiding the crisis entirely. 6. How companies can avoid the trap. Avoiding this trap is simpler than most think, but it requires discipline. Measure the right things. Focus on long-term indicators like customer retention, profit margins, cash flow, and employee satisfaction, rather than just revenue or signups. Create a balanced scorecard. Combine financial metrics with operational and customer metrics. This gives a 360-degree view of business health. Question assumptions constantly. Just because revenue grows doesn't mean the company is healthy. Ask, are we retaining customers? Are we profitable per customer? Are we sustainable without external funding? Align incentives. Employees and leadership should be rewarded for metrics that drive long-term value, not just short-term growth. Companies that implement these practices tend to survive downturns and maintain profitability for decades. 7. Lessons for entrepreneurs and leaders. The story of the one bad metric is more than just a cautionary tale. It's a lesson in humility for every entrepreneur and business leader. Profits alone can be misleading. A company might look successful on paper, celebrate record-breaking revenue, and attract praise from investors, but beneath the surface, cracks can be forming. Many leaders fall into the trap of chasing numbers that feel good. These are called vanity metrics, things like total signups, page views, or quarterly revenue spikes. On the surface, they look impressive, but they rarely tell you whether your customers are happy, your employees are engaged, or your business model is truly sustainable. The key is to focus on actionable metrics. These metrics reveal hidden risks before they spiral out of control. Even profitable companies can collapse if one bad metric drives every decision. So, the real goal isn't just to grow, it's to grow wisely. Measure the right things, stay disciplined, and build a business that lasts, not just impresses. Thanks for watching. If you enjoyed this video, don't forget to hit like, share, and subscribe.